All right, guys. Well, thanks for joining. Happy 2021. So today I want to do a couple things. We have limited time today, as I explained before starting recording, but we have laid out the historical financial statement. And the important takeaway here is to remember that in an income statement, what's reported, let me see if I can pull up the file, what's reported is not always how we want things to be laid out in an income statement for analysis purposes. And the way I like to think about things, or at least identify things, is when you look at line items on an income statement, there are 9 major areas where these line items could potentially go. Okay, so there are 9 major areas. Let me pull up the operating. Whoops. There we go. 9 major areas. Okay, so we took a look at Amazon's financials, and you might not have seen it this way, but I had laid things out in 9 major areas. Okay, namely, 1, revenue. Area 1. Okay. 2, costs of goods sold. 3, operating expenses. What I'm trying to say is each of these line items that the company is reporting should be placed into one of these major segments. Okay, revenue. Here they have laid out.
Well, yeah, well, that's how I've come to this point.
Say, okay, well, which ones should go into cost of goods sold? Which ones should go into OpEx, cost of sales? Obviously, cost of goods sold. So 1, 2, 3 OpEx, 4 other income. I'm talking about hard-coded areas. I'm sorry. 4 depreciation amortization. 5 other income. Actually, maybe I wasn't so wrong before, because it could very well be that other income is above EBITDA. We spoke about that a couple classes ago. 6, interest expense, interest income. 7, income taxes. 8, non-occurring events. We've identified none for Amazon. And 9, payouts, meaning distributions or non-controlling interests. When I say distributions, I mean dividends, sorry. So when you look at a produced or audited annual report, there are 9 different areas where those line items can go. And then it's up to you as an analyst to identify these totals, EBITDA, EBIT. So this is a way to think about it. This is the analyst's way to think about it. And then we have net income and earnings per share. Let me take those highlights out now. So now how to project. And we started to talk about making projections. We started to talk about good areas to look for in making projections. I talked about, this is where you want to skim through the management discussion and analysis, where they talk high level about where the company is going. I talked about researching. The best thing to do is researching analyst reports. And I spoke about how you'd want to ideally have an analyst report and have your numbers kind of in line with what Wall Street's projecting, because those analysts probably have worked with the company for years and have relationships with the company. And we said, obviously you may not have access to those expense reports, but we went to Yahoo Finance, and Yahoo Finance actually has a summary. It's very powerful. A summary of, I think Amazon had 46 analysts on the street. So when we're making projections, we should pretty much be in line with what the other analysts are saying, unless we have really good reason to not have our future projections kind of in line with 46 analysts. So we'll go through that again. But from a technical perspective, you first want to project revenue. Now, what we had done was we had looked at the average analyst's street estimates. Let's just pull it up instead of dancing around. So you go to, let me share my web internet. So you go to share. So you go to finance.yahoo.com. This is the best first step. Amazon, here it is, Amazon. And then you have a lot of live statistics. Then if you go to analysis, this is what 46 analysts on the street have estimated. It's amazing, very powerful. They say that on average, next year's revenue, 2020, should be $379 billion, an average of 35.5% growth. So I said, okay, let me enter 35.5% growth. Now, one thing I didn't tell you and that I ended up doing is I tried to project the individual line segments. I tried to say, okay, well, how does that revenue break out between the two? And you know what? I just couldn't get any information on the growth of net product sales versus net service sales. And, you know, even I went to the annual report, I went to investor presentations, and even I noticed the analysts are not projecting those individual segments. It doesn't matter. It doesn't matter. For our valuation, we just need revenue growth. The only way it may matter is sometimes an associate might ask you and say, all right, well, I want to see the percentage of product sales versus service sales. And you can easily get that historically, right? I could just take a piece of the pie. I could say, okay, well, what's this 160 million divided by 280? Well, that's, you know, was it 46%, 47% of the total? But it's not going to help us estimate a stock price because the average analysts on the street are projecting total revenue as a whole. So what I did was, and I set this out in the template, but if you want to do it, I deleted this area and I said, well, let me just project the total revenue. I created a formula that said, let's just do it together. What I did was I created you can delete the whole thing if you want to just do this with me. And I said, all right, well, analyst on the street says 35.5. I'm going to go 35.5%. That's a hard code. And I projected growth. I said equals the year before times open parentheses, 1 plus 35.5%. Copy to the right. What does that give me in terms of total revenue growth? 380 billion. Very close, 379.98. Good. On average. Now, what do you do for the years going forward? It's so tricky for a company that's this massive. And what I'm going to do is a little rough, and with the knowledge of we're going to tweak this further once the full model is done. We're looking very high level right now. And what I'm going to do is I'm going to look at what they said for the next year. They said for 2021, on average, it's 18.3. So I'm going to drop this to 18.3. Okay. And you know what? What I'm going to do is I'm going to expose the decimal here. So I'm going to go and highlight every single cell in this row. And, you know, if you want to just use this decimal key, you can, but just sticking with the nature of I like hotkeys. I'm going to go Control 1. Okay. Whoops. And Control 1 is going to open up my format box. It says decimal place is 0. I'm going to go out to 1, hit OK. There we go. Okay. So what I did here was I noticed that their drop was significant, down to 18.3%. I'm going to dig into this further once the model is done, but I'm just going, let's just get something going. Again, this goes back to the theory of, you know, if your associate had staffed you, had assigned you this model, you don't want to spend too much time doing research and not have a product to show your associate. Get the mechanics down. You could do a quick high-level research, good, but don't spend too much time dwelling yet. So 18.3% says on average 449 billion. And so the way I took a look at this for now is I said, all right, well, wow, that's quite a drop. I'm going to look into why they expected the drop, but you'd always expect your revenue to scale down over time as the volumes increase. So I said, well, let me look at what sort of drop this is And I'm going to repeat that drop. Okay, so what I'm going to do is this. I'm going to add a second metric here to show the reduction in the percentage growth. Was about less than 20%. So I'm going to add a second metric here. So it can get a little tricky. So what I'm going to do is I'm going to add a row. And the quick way to add a row is I'm just going to put my cursor somewhere underneath any one of these percentages, and I'm going to highlight the whole row. To highlight the whole row, shift spacebar, shift spacebar, hold down shift, tap spacebar, highlights the whole row. Quick way to insert, control shift plus, hit all those numbers at once, control shift plus. Okay. And now to keep my formatting, I'm going to copy this whole row down to keep my formatting, and I'm going to change that into a different percentage. So I'm going to highlight this row now. So I'm putting a cursor anywhere around this row, shift spacebar, and I'm going to copy this down. To copy down, I'm going to do a big control D. First, I'm going to highlight down, shift down arrow, control D, copy down. Okay, so maybe went a little quick for you guys. That's why I'm recording this. You can go back and take a look. Okay. So somebody asked a good question. Is it necessary that the growth is constant? No, and that's where I'm going. It should always scale down a little bit. Well, no, it doesn't. It could increase. I don't want to say it should scale down. I'm going to have it scale down. Most analysts have it scale down a little bit until they know more information. So this is going to be the year over year revenue growth change. So I'm going right to the question of, and you know, if you look at, I'm going to delete this. What I'm going to do is I'm going to calculate what this change was. I guess you could have had it historically, but yeah, okay. So I'm going to have simply equals 19 minus 18. So that was a 10% drop in growth, right? I want literally the percentage drop straight. You could have done a percentage drop. I'm just going to do percentage drop. And then I'm going to copy this formula to the right. So shift, tap to the right, control R. And I'm going to see this is a jump in 15 points. It was a drop in 17 points. All right, sorry, I'm looking at my solution. We need to be doing this on a percentage basis. I don't know what I'm thinking here. So sorry. Interesting to see that drop, but I'm redoing the formula. Equals this year divided by last year minus 1. I want a percentage drop from the year before. There we go. 33%. That's going to give me too much of a drop if I did it just by subtracting. So this is a 33% drop. This is a 73% increase in the percentage. This is almost sliced in half, right? So 2021, they dropped the revenue growth almost in half. So what I'm going to do for now, until we have the final model, until we know better about the company, I'm going to assume this percentage is going to drop by about 48.5, 50% going forward. That's going to be my running assumption going forward. Okay. So 2021, we have analyst projections. 2022, what I'm going to do is my projections are going to be equals the year before, 48.5%. That's my assumption. Because that's my assumption, I'm going to make that blue. That is the driving assumption here. Side note, this is something that always bothers me here. This shade of blue is a little bit lighter than that shade of blue. I don't know if you guys care, if you're starting to color your model and things like that. I'm going to show you how to fix that. I'm going to show you right now. If you hit Control 1 and you go to your font color, here's your font color. you get a little bit more detail than the font up here. So the color, this is the color that I selected. You can go to more colors, and I can actually, this is a true 250 blue. For some reason, this is a blend of red, green, and blue. I'm gonna make red 0, green 0, and blue 250. Okay, add. Okay, guys, this is my assumption for now. If you open discussion, send me an email if you feel like there should be kind of other ways to do this. I know there's more accurate ways to get into future projections, and we're going to get to there, but in terms of scaling down, if you have any suggestions, let's have an open discussion. I think it'd be fun. But if this is going to be cut in half, what does that mean? What will our 2022 projections be? It'll be last year's times 1 plus, sorry, open parentheses, 1 plus 48.5. Whoops. Cut in half, 9.4%. I'm going to repeat that going forward. So you're scaling down. Maybe a little too aggressive. I'm making this black font because I'm showing an associate. This is what was driving the first 2 years. And what I really should do is I should say, as per average Yahoo Finance, right? Finance, average analyst research, right? And I would do that for this one too. And then here I would say based on previous approximately 50%, whoops, growth estimate reduction. If I had done straight subtraction, right? Oh, that was, what do they say? The subtraction was pretty significant. That was not going to work, right? If I did 17%, this would be 1%, and then this is going to be negative, right? And I don't expect their growth to decline. I just expect their growth on this massive scale to reduce. This might be a little too aggressive. A 0.7% growth might be too aggressive, but let's see what this means in terms of the average stock price. Again, send me an email. So that's the way I'm thinking about revenue growth, okay? Now, a couple other things I'd emailed you that you can use for detail for projection estimates that that I recommend always looking at is the third quarter report, which we're going to use for our cost estimates. And also I found a presentation on their investor relations site that talks about their latest financial results, investor presentation. You can look through this and they usually always have projections. So here's how their cash flows up. We can use that later. They talk about their share count, which we're going to use. Actually, this is going to be very valuable for us. Here's net sales up 37%, or say up 30%, 36% adjusted for foreign exchange. That's what we had, right? 36%, 35.5. Right? Apparently the analysts have 18.3. I'd love to see a 5-year growth. Okay. So this is going to be valuable for us. You got to keep getting, digging in and getting more information. And you know what? Since it's January 2021, they may very well produce within 45 or 90 days another quarterly report. And that's going to give us more information. And we can go back and tweak our model further. Okay. Expenses now. For most expenses, usually 90% of the time, they're projected as a percentage of revenue. And you can look here, our historic percentage of revenue, 63%, 60%, 59%, pretty standard. So I would assume, let's say the last 2 years, if it was around 59, 60% going forward, that's going to be that going forward too. The only thing that I might dig into deeper that's a little bit interesting is that these percentages have been dropping. Here, more dramatically than here. But for now, since this drop is only about 1%, to get the model going, I'm going to just take last year's 59%. Okay, or you can, I'll do equal last year. If you typed in 59% versus equal last year, you're not going to be wrong. Your numbers might be a little bit different than mine because this might actually mean 59.111344, whatever. There's no right or wrong here. For consistency, let's do equals the year before. And actually, I like doing that because if your associate sees, they look into that formula, they'll see why you took 59%. You're just taking the last year's for now. But I am going to make it blue because even though it's a formula, this is my assumption driver. And I'm going to back into the value by taking 59% times revenue equals 59% times revenue. There you go. That is my projected assumption. The one thing I'd want to look at here, though, is should this scale down further? Again, I don't know if anybody knows how to permanently. So you have to go back in and now somebody might know how to, and probably if I look into it, I want to make this recent color a standard color now. I guess I can't. Anyway, there might be a setting to do that. Okay. Gross profit. Now we have projected gross profit. Pretty consistent. Okay. OpEx. For most OpEx, let's again, look how similar this is. 14, 15, 14, 6, 6, 5, 6, 6, 7, 2, 2, 2. I'm just going to take the last year's. So for fulfillment, I'm going to assume it was last year's. And I'm going to back in to that fulfillment number by taking 14% times revenue. Okay, copy to the right. I'm going to do everything down, then I'm going to copy everything to the right. Technology and content, take the last year's, equals. I'm going to go a little fast because you can always go back and look at the video. 7% equals 7% times revenue. Oops. There we go. 2%, 2% times revenue. Okay. Now, so for most expenses, very simple. Percentage of revenue. 90% of the time, that's the way it's driven. When you get to other line items, other operating expense that I've highlighted, okay? Other income that's swinging. These line items are not as steady and consistent. How do you project these? Always get this question as an associate. This is a very difficult thing to think about. In order to simplify and break it down, a couple things. One is, remember, we're looking high level. We're looking at an estimated stock price. So sounds funny, but let's look at this. 214, 300, 201. The difference between 300, the maximum here, or 200, $100 million, is not going to really change our analysis. Not when we're dealing with $380 billion in sales. It's crazy. Okay, but you still want to find some technical way to delineate this. And so what I've realized and deduced is that there are really, no matter how you look at it, no matter what research you do, there are really 7 ways you can make a projection out of an unknown line item. 7 ways. 7 ways you can project anything, to be honest. Okay? For the most part. There can always be some other creative, but this is the general method. 1, you can be conservative and take the maximum, and I'm talking about projecting using historical information. You can take the maximum. This is in my book. I have 7 methods of projections, okay? You could take the maximum and A lot of people like that. I like that method in a lot of cases because taking the maximum is being conservative, right? I'd rather have a conservative model. Okay. 2 is you could take the minimum. Now the minimum is being very aggressive. I'll never take take an aggressive stance. Let me do it this way. I don't have my OneNote up, but 1, maximum of 3 years. Okay. 2, minimum of 3 years. Okay. 3, I can take a percentage of another line item. We use this with our costs all the time, percentage of revenue. Right now, I could have taken percentage of revenue here and it gave me like 0.3%. And that would have been sort of okay. But I just wanted to really use this line item to demonstrate the 7 methods. Okay. Number 4, I can repeat the cycle. Okay. This is common in things like, okay, here we go. Other income where it's negative, positive, negative, positive. A lot of times that means these are stock investments. You're buying and selling and buying and selling. Repeat the cycle. 5, you can use a growth trend, whether that's positive or negative. We do this for revenue. Right? If it's steadily increasing or steadily decreasing, you can repeat that trend. Okay. So, 6, you could take an average. Average of 3 years. Oops. Okay. Average of 3 years may actually be the most effective here, right? So in this case, you know, the point I'm trying to make is I'm just looking technically as to how to think about making projections, and no matter how much how much research you can go through this to back up your data. Technically, you're going to probably look at things from one of 7 different methods, right? So this goes back to the point where you can make do all the research in the world. I got to start upgrading, guys. We'll do all the research in the world, and it's going to come back to one of these methods, right? Okay. And then the last one that I commonly use is taking the last year. In other words, taking the last year's metric, right? In other words, and we do this with these projections, right? Last year's metric is most indicative of our next year, right? So when you look at these numbers, which is a little interesting, you have 214, then it pops a little bit, then it drops a little bit. And, you know, from the larger kind of scheme, from the larger perspective, it really doesn't matter if you ended up taking the middle one or the last one. You're talking about $90 billion. As a percentage, when you think about what you're doing, it's not going to make too much of a difference. And again, one side thing, a comment to make is it's always very important to look to research what this line item is. And they don't, because they might talk about, well, it's dropped last year because, or they didn't really talk too much about it. So first of all, when knowing these are the 7 most likely possible scenarios, you can first, right off the bat, eliminate some that don't make sense for this line item. For example, taking the minimum, I'm going to cross out. Okay. Where's my strike through? I'm going to cross out the minimum because I like to build conservative models, and I would not take the minimum 3 years. Minimum 3 years would be helpful in, like, say, the cash flow statement, or let's say minimum revenue, when the minimum is actually a conservative estimate. Okay. Repeating the cycle isn't going to work here because this is not cyclical. Okay, it's going up a little bit. It's dropping significantly. If it was negative, positive, or if it was up, down, up, down, up, down, and I went back a few years and it wasn't. It was bouncing all over the place. Growth trend doesn't make sense because there are no trends here. It's not steadily climbing or steadily reducing. You can see how I'm, even without really knowing what the line item is, slowly narrowing it down to possibilities. Average could work. Average would be viable. Taking last year would work. Okay. So now I've logically narrowed this down to several possibilities. The maximum of 3 years would have given me 296. Okay. The average would have given me 237. I'm gonna just show you. So 296, 237. Okay. The last year would have given me 201. Okay. And then let's say percentage of another line item. Let's say if we did percentage of revenue. I'm just going to do quick math on the side. So if I took 201 as a percentage of revenue, okay, and I applied that next year's revenue, what would that give me? 272. Oh, well, okay. So my point is, I could have done all the research in the world, and it would have led me to one of these methods. I'll tell you right off the bat, without knowing anything, I don't like 201. That seems to me the most aggressive. I'm going to eliminate that method. And so I could have taken the average, which would have given me 237. I could have done the percentage of last year, which would give me 272. Actually, that sounds pretty reasonable. What I'm going to do for purposes of illustration here for our class is I'm going to take the maximum of 3 years because it's the most conservative. But know that when we, just to show you, when we build our two things. When we build our full model and valuation, the difference between 272 and 296 and 237 is not really going to change anything. But also know I narrowed the possibility from $100 million down to a window of about $50 million. So I narrowed down the possibility without even knowing what this operating expense is. To be extremely conservative, I'm going to take the average. I'm going to take the maximum of the last 3 years. And I know it's easy just to say 296, but I'm going to write out the formula so my associate knows what the thought process behind what I was doing. Equals max, open parentheses. I highlight everything, close parentheses, copy to the right. Okay, now I think for the book, when I write this book, to be fair, I'm not going to talk about all this. I'm just going to take a percentage of revenue as I did with everything else because it's an operating expense. But I want to introduce this topic here because it's a very important topic in terms of how to narrow down expense line items on things that maybe may otherwise not have been clear. Other income. You'll see a lot of lines in the cash flow statement that talk about that. But no, had I taken a percentage of revenue to 272 versus 296, that's not going to change things very much at all, is it? Okay. Once you have that, okay, we'll copy down OpEx, EBITDA, EBIT, and guess what? We've projected our EBITDA, which is core for valuation. You know, I'll tell you, even with our really minimal scaling down growth, this jump for 7 years out from 58 to 70 billion is a pretty significant jump. So I wonder what their 5-year growth is. We're going to look at that later. Next week, we're going to talk about getting all the way down to projecting EBITDA. And then we have other schedules that we need to build depreciation, to build interest expense, interest income. All right, guys. So listen, take a look at that investor presentation. Do some further research on revenue. Think about ways to grow that if you'd like. Practice those formulas, and we're going to continue to build this down for next week.